Welcome to the weekly update, where I'll go over the action in the market for the week of February 5th through the 9th, and then we'll see how things look for the week of February 12th through the 19th. We're pretty positive. Of course, you can't get much more positive than setting all-time highs, and for the first time ever with the S&P 500 crossing above 5,000. I wish it were always that simple. There's always things we need to be concerned about. Just because we're making new all-time highs and we are going higher, we have to go with price. That's the ultimate indicator. There are still some warning signs, even though we are looking positive for right now. And I'll go through and point those things out in the video. Before I get started, please know that there's a PDF of every video that I post either on YouTube or Rumble that you can download. You can follow along with the same slides that you see right here. I also have the same charts that I use in that particular video. Some folks find that helpful. Also, every day I update a thing called pivot points. There are pivot points that last for the whole month, but I update that every day with the previous day's bar. And then there are pivot points that last just for that particular day. And we hit those pretty heavily. When you look at the intermarket or the intraday chart that I'll show here in just a minute, you can see where those points really come into play. So it's really helpful to have those. And the cool thing about the pivot points, they're calculated before it even happens. So this is something that we can actually see right before price even gets there. Also, I do have a private Facebook group. It's just not very active. If you want to join the group and maybe try to make it a little more active, you're welcome to do that. But it's there if you want to try to make use of that. I will be posting a new poll. I haven't posted the poll for the upcoming week. I'll be going through the results of the previous week here in just a moment. And then I do keep a real close tab on YouTube comments as well as Rumble comments. If it's spam, if it's garbage, if it's these crap posts that go around, I get rid of them right away. I want to have a real back and forth between us. And so if you want to interject something, whether you agree or disagree with my conclusions, you're more than free to do that. That's not what I'm talking about. I want to have honest dialogue going back and forth, even if we don't always see eye to eye with things. Then I also post on Rumble, as I mentioned before, down here at the bottom. This is the link to the Rumble channel. I did have some problems earlier in the week posting to Rumble. So the YouTube video was up quite a bit before the Rumble video was up. Sometimes I have the reverse of that, where I'm having trouble posting to YouTube. If it's about the time that I usually post and you like to watch the video as soon as possible and it's not there, feel free to jump over to the other platform and see if you can find it that way. All right, let's go back and talk about the session that just ended here. For the week, we were up 1.37%, which is kind of interesting. Last week, we were up 1.36%. Not huge moves, but still up moves nonetheless. We were above average with volume. Now, there is a concern that we're running into, and when I get into the daily charts that I go through, there's this idea that we should see an increase in volume as prices going up. We can also see an increase in volume as prices going down. That's one of the indicators that we look at to show that there's a lot of conviction behind a move. Well, as we were breaking out to setting new all-time highs with the S&P and then going above 5,000 in Friday session, we've seen volume really dropping off. But for the week, it was above average when you take it all together. We are positive with our technicals. We have some extreme positive things, and there's some things I want to point out to you as I go through the different charts here. It's about inflation and interest rates. We didn't have an awful lot of economic reports that were really pivotal as far as giving us some insight right now. That's going to be coming out this week. We're going to get CPI, retail sales, and PPI. Those are big, important reports that'll give us some kind of a reading on what's happening economically. We did get a little bit of Fed speak throughout the week, and then last Sunday, and as I have in some of my notes here, Chairperson Powell appeared on 60 Minutes, and I'll go through more of what he talked about here in just a moment. Our trend is still strengthening, and the green line is on top. So that is positive for right now. We are above the moving average. So in the longer term, we still have a solid uptrend. We're developing more into an uptrend in the short and intermediate term on the daily charts, but the green line is getting pretty extreme, and it can go higher. than where it's at right now. But that, in combination with a lot of other things, suggests that we are overbought. But we've been overbought now pretty much for all of 2024. There's a little few days in there when we weren't, but that's what can happen when we're in a positive environment. We can stay overbought for a long time. That's what another reason why I use a lot of different indicators, because some are flashing, we're looking good. And it just keeps telling us the same thing every day. Where we have a different chart, it's like, wait a minute, we're getting a little bit of a different story when we look at it from a slightly different angle. All right, so for the week, the Dow ended up being unchanged. It had some earnings issues. Remember that it's only 30 stocks. That's one of the reasons I don't really focus on the Dow. I know the financial media does, but I don't. The NASDAQ was up 2.3%. The S&P was up 1.4%. They rounded it up. And believe it or not, we had an up week with the Russell 2000 small caps. It was up 2.4%. Still a long ways to go. We can pretty much flush the old January effect down the toilet. It was there for December, made no appearance in January. Now they're coming back, and there are some areas of strength, but we still have a lot of repairing to do when we're looking at the small caps. So here are some points that I just took away from the week. We did have a positive week. We did see small caps show some rebounding action. The S&P did close above 5,000 for the first time, and we saw it kind of changed throughout the week. There were days when we saw more broad participation. There were other days when we saw the mega caps do well. Well, by the time we finished the week, both ended up doing okay on the week. And there's been a real lack of selling pressure. It's not that people are in there buy, and really driving price higher on an increase of volume, but people are just kind of riding this wave right now, wondering, okay, well, as long as we're not really starting to head back down, I might as well hang on to this. Maybe we'll just keep going up a little bit more, even though we are in an overbought condition. Then we're still dealing with earnings season. We had reports come out from Ford, Eli Lilly, DuPont, Arms Holdings, Disney came out, and Amgen, as well as PayPal. Some of these were positive, some of them were negative. Interest rates and the US dollar index continue to climb. This is one warning sign. We're seeing the 10-year yield just continue to go up and up and up. And I'll show you that here in just a moment. Stocks don't like that, but stocks are going up, even though that's happening anyway. What's going to give? Are interest rates going to start to come back down? Or is the stock market going to finally go, wait a minute, we don't like what's happening here. We better start selling because interest rates are going up too much. And also the dollar going up tends to put pressure on stocks as well. It's still in a longer-term downtrend on the daily chart, but it has been rebounding pretty much since the beginning of 2024. And then last Sunday on 60 Minutes, Chairperson Powell, he appeared on the show and said that the Fed needs to see more evidence that inflation is moving sustainably down to its 2% target before lowering rates. The market didn't really like that. We had some pressure underneath the market in Monday's session. It recouped that, but at least we didn't get off to a really positive start. And then economic reports were rather light when we compare them with other weeks. But in Friday's session, this wasn't an official report that came out, but they did say that, oh yeah, we went back and looked at past ratings of inflation and numbers, and they're pretty much the same as what we came up with. So the market liked that, and that's where we got a bit of the upward bias in Friday's session. This is a chart that I've been showing for quite a while now, mainly just follow the blue line here. For a while, this orange line is what we had been doing, and we're comparing it from 1966 to 1982, where we're possibly still in this downward sloping part of inflation. The reason I keep showing this chart is not because we're going down. We're tending to see that in the economic reports. But look at what happens after. And I'm not saying this is what's going to happen, but it certainly happened before. So we just want to be aware of this. That's why we watch the bond market. That's why we really keep an eye on interest rates. We don't just focus on one little thing here, because no market exists in a vacuum. They all interact with each other, and sometimes a lot and sometimes not very much. But we want to know that when this same kind of pattern existed before, we ended up seeing really strong hyperinflation back into the late 70s before it finally started to get under control. And you can watch any other YouTube videos, you can read things, you can listen to people, and they're just predicting the end of the world. And they'll say, this is definitely going to happen. And so everybody makes their decision based on that. And then you listen to somebody else that says, well, no, things are looking pretty good. The fundamentals are pretty strong. Longer term is really improving right now. And so then you might listen to them, but then you're confused because you're getting different messages. That's why I try to let the charts do the talking for us. We use a chart like this just as a guide, not necessarily to make decisions. This is another one. This is where we're above that 4.02% for the 10-year yield. Just a week or two ago, we were below 4%. We shot up above and then we came down below. Now we're up at 4.19%. And to this point, the stock market is really not reacting to that. Here's the poll results. These are as of a week ago when I posted these questions. Do you feel that prices will resemble historical norms? And that's kind of what I'm focusing on in this video too, by being positive until about the middle of February and then declining into about the middle or so part of March. Everybody who responded thinks that that's what will happen. And that's kind of what I'm going with right now. It's not going to play out tick for tick. It may deviate from that. It may come in totally different. But I have found that looking at seasonality tends to be a really good guide, at least to work from, to give us some kind of a benchmark to build off of. Then there were some concerns that we started to hear last week about the New York Community Bank. I've been showing a daily chart of that stock in the daily videos. Do you feel that this is isolated or that there will be more to come, basically? Everybody who responded says, no, there's more on the way. And that inflation chart and the problems that seem to be just eluding the market right now is something like another one or two, or who knows how many banking problems coming back into the picture. Is that's what's going to finally shake the market? Or is something like that even going to happen? We don't know at this point. Then the FOMC pretty much took the rate cut off for March when they met. Do you feel that there will be rate cuts later in 2024? 86% think yes, they will. And so far, that seems to be the prevailing attitude, where 14% said no, they're not going to cut rates. And then, are you concerned about the short, intermediate, and long-term negative divergences? And that's what I'm pointing out again in this week's video. The market doesn't seem to really be paying attention to them. We're seeing these negative divergences become even more pronounced than they were when I did this video a week ago. Well, 60%, yeah, they're concerned. 40% are not concerned. I'm concerned about them. Not that I'm necessarily going to make decisions based on that, but I want to know that they're there. And if I see things really start to turn and go down, now I have some reasons as to why that could be happening. Price, as I've said, is the ultimate indicator, not necessarily any of these charts that we look at. Okay, here we're still looking at earnings projections going out into the future, and the red arrow just continues to go up. That justifies prices going up as well. Then here was another interesting chart. It says in 2023, an unprecedented number of stocks underperformed the market. Well, we heard about the big mega caps, the Magnificent Seven. Well, when that happens, and they're pretty much carrying the indexes these days, way over here on the right-hand side, we see that there were an awful lot of stocks that did underperform. Then looking at consumer confidence, it's still below pre-pandemic levels. Just think about it. Doesn't 2019 seem like a century ago compared to what everything has happened since that time? But we're still below where we were feeling back then, despite strong economic performance. And that's a relative thing. I mean, yeah, the reports are positive and inflation is coming down, but you can also twist around, and I shouldn't say twist. You can also interpret some of the data that's coming out to say the economy is really not that strong. Does the economy feel strong when you go to the store, when you fill your car up with gas, when you look at your paycheck and you see that part going down and the other price is going up? But this is just kind of an interesting chart where we take the Twitter Economic Sentiment Index. Yeah, that's real scientific. And then consumer sentiment, which is an indicator that we follow. And then we also follow consumer confidence, and it just rates them over here on this side. And what I'm taking away from this is we're seeing them all tending to show some improvement for the most part. except the Twitter folks, or X, whatever you want to call it these days. They seem to be a little more pessimistic. All right, so fact set, we're still dealing with earnings season here. Here's the chart just showing that analysts are making smaller cuts than average to their earnings per share estimates. So they were really projecting earnings to go up, and then that seemed unrealistic. So then they cut them down. And now the companies are coming in looking like, wow, look at this. We beat our estimates. Is that what's happening here? I know it's a game that goes on, but it's a game that the market falls for. Just like these economic reports, you can come in and talk about the weakness of these reports and how they don't really tell the real story, but it's what the market uses to make its decisions. But way over here on the right-hand side, this is how the estimates are being changed, at least to this point. And then this is also trying to be represented on a chart. Then we have an update with earnings with all this convoluted writing here, where as of Friday, 67% of the S&P 500 companies had reported, 75% were above estimates, and which is below the 5-year average and above the 10. That just plays with my mind too much. In aggregate, or taken all together, earnings, they're 3.8% above estimates, which is above or below the blah, 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 blah. However, it's also above last week's number of 2.6. Historical averages, again, this is taking into account that they're treating all the S&P 500 as though they have reported, where a number of the companies, 33%, have yet to report. Here is the intraday chart, where we were under a bit of pressure. You don't really see this all that well in Monday's session. This was the market reacting to what Jerome Powell said in 60 minutes, but then we were able to recover. We saw some early weakness, but then some more late day strength. Then in Tuesday's session, that was like, okay, wake me up when it's over. But then we shot up in Wednesday's session enough to where I had to put R3 on here. This is when we really started to look more positive. And we're like, okay, I'm at the beach on Thursday. Nothing's really happening. And then in Friday's session, we ended up opening higher and then closing up above R3 here, and actually getting above, we opened above 5,000 and we stayed above it for the whole session. So for the week, here is a look at the indexes. These are just the 5 trading days for the 5th through the 9th, where all of the indexes were up, and we actually saw the small caps performing about the best, just in the 5 trading days. When we go back to the beginning of the year, all of the indexes are positive, except the small caps are still negative. Looking at our sectors, and I have 2 charts to show you here. First is just sorted according to, since we had an up week, what was up the most? The tech sector. Discretionary, which that's been a concern. We saw some improvement, especially later in the week this week, with discretionary starting to perform better. If that keeps performing better, we would like that if you're more positive on the market. And at the bottom, we had energy, communication, which has been really strong. It ended up being down. And then staples and utilities. Staples have been hanging in there a little bit better, but utilities have been under a lot of pressure. Then on the next chart, I look way over on the right-hand side and I sort it that way from the scooter score. The higher the score, the more positive it is, where we have tech and communication looking the best, coming in the 90s, followed by financials. They haven't fallen apart yet. The financial sector is still going up. Is that going to create some kind of a problem if more banks? So far, it's been more of a regional issue. Is this going to feed over into the whole financial sector itself? Then on the bottom, we have energy and utilities, which are not doing very good these days. Here's our relative rotation graph. Again, think back to your geometry class. When you're up in the upper right-hand corner, that's a plus plus. So these are the strongest areas of the market. We're seeing a little bit of an improvement here with real estate and financials. And then also with tech, and then communication, it's seeing a little bit of weakness, but it's starting to come back up into this area. And then we're way over here on the minus side, we're looking at energy, which has been under a lot of pressure. So looking at the sectors, just for the 5 trading days of the week, we had discretionary, materials, tech, and real estate that were up. The rest of the sectors ended up being down. Going back to the beginning of the year, tech and communication are doing the best. They're up, where all the other sectors are negative. Looking at sentiment, this is another thing. We're getting to that point where we're getting above 75 now. When we get to that level, that's when we roll with it while it's going up. But when we get above that 75 level, that means that we're looking at, okay, people are getting a little too exuberant here. And this is really more helpful when we look at the historical chart. We see when it gets up to these high levels, and it could still go higher than where we're at right now. But this is usually where we top out in the extreme category. Now, we got up a little bit into here and then fell back. Now we're starting to come back up right now. And so we're not necessarily making decisions based on this. You might, but we just want to know about this ahead of time, that people are they're starting to assume that the market's going to go up, and the market doesn't like that. This is another reading. The active asset manager starting to get extreme positive again. And here's another look at that same number coming in at 93. When we get really extremes, when we go above 100. So this could still go up further, but it's already looking pretty extreme. Then we're looking at the VIX, which measures the fear in the market. This continues to give us very low readings. We did decline over the past week with the line chart and the bar chart, and we've been getting very, very low readings at this point. Looking at the Ulcer Index, another fear gauge, also giving us very low readings. And this suggests that there's not a lot of fear in the market. This is starting to go back up. It's kind of interesting. Now, there's a one-day lag on this. This is Thursday's close, where you're getting folks that are getting a little bit more defensive when we look at the RIDEX bear to bull ratio. When this goes up, that means they're getting in the bearish funds. When this goes down, that means they're more in the bullish funds. And the fact that this is going up is actually kind of interesting, because usually these folks tend to follow what's already happened. We did get the latest reading from the American Association of Individual Investors. Not a change, really. They're still looking pretty positive and not necessarily extreme positive. We also follow the red line moving average, which crossed above zero and is showing some improvement. We're still looking positive when we compare cash to the tech sector. The black line continues to go down. Then here's some economic things to look at. GDP, this is the latest reading from the Atlanta GDP Now estimate, where they have us at about 3.5% in the latest reading. If you talk to economists, they're coming in a little bit over 2% and about 0.75%. The takeaway from this is, no matter what you look at, we're still getting positive GDP. This represents the same thing on a bar chart, where we are coming down with the fourth quarter. Now we're starting to focus on the first quarter of 2024, where all of these bars continue to be positive. We're also continuing to go down when we look at the spread between risky and not as risky bonds. As this goes down, that means there's not a lot of fear or not a lot of concern in the market. The Chicago Financial Conditions Index also is continuing to decline. That's positive. It's when we spike up, that's when we get nervous. We're also coming down with the tightening standards that banks are putting on folks who are loaning out money. It really started to get a lot stronger now that it's been coming down. The problem with this chart is it's so delayed. This is a quarterly chart, so we go 3 months before we'll get the next reading in this chart. Then we did have an update last week with the real-time SOM recession. Okay, let me try that. Real-time SOM rule recession indicator. We're coming back down. We're above the black line. That's a little bit of a concern, but we're below the red line, so we're okay with that. We also had another reading recently with the smoothed recession probabilities. We're barely above the black line. We get concerned if we get up to the red line. And then the Brave Butters, this was updated right at the end of January, where it's starting to come down a little bit. When this was going up, that was producing a bit of a concern, but right now that it's coming back down, doesn't really suggest that we might be heading into a recession based on this chart. Keeping an eye on inflation, and we're going to get CPI and PPI this week. CPI is going to be the big one, and you can see the daily adjustments that are made to what people in the market think inflation will be. Looking at the Fed, they've taken off this idea that they're going to cut rates in March. Now there's an 84% chance that they're going to leave rates right where they're at. Just to give you an idea, this really picked up steam after the Fed meeting, because this is right now, a day ago, a week ago, and a month ago. It was really starting to pick up the idea that maybe they'll cut as soon as March. Now it looks like there's a lot less folks that are really starting to think that, as this probability tends to go down. Now we're starting to keep an eye on the May 1st meeting. Now the market's looking out to that meeting, and right now there's a 52.2% chance that they will cut rates 0.25%, because they're at 5.25 to 5.5. If they cut it, they would be at 5 to 5.25 here. And that's how this has changed just recently here, where today, previous day, week, month, a lot more folks are jumping into this camp. But that's going to change all the time as economic reports come out. We're still declining with the Fed balance sheet. When we look at it on a year-over-year basis, it looks like it's going up, but we're still seeing minus signs when we look at the raw number. Keeping an eye on breadth. We are looking positive with price, and we're actually starting to break out. Here's another negative divergence. We're positive when we look at volume, but we have not broken out above these previous highs. And we're seeing that on the daily charts too. Volume is lagging behind price. In a more positive environment, when we're going up, we want to see volume actually leading price. When we look at our new highs, new lows studies, we're starting to come down with our 4-week moving average, but we still see right here that there's more highs than new lows. And we're starting to turn down slightly with our 10-period moving average. We're positive, though, when we look at the advanced decline ratio, since we're above 0. Accumulation distribution is also positive and above the moving average. And then here's our trend, where the black line is above the moving average. That means the trend is getting stronger. We're above 20, so that means we are in a trending environment. The green line is on top and advancing, so we default to the positive trend. We look at the Erin indicator. The green line's on top. The red line has been coming down. That's why we see the oscillator itself above 0 and continuing to advance. The mass index is not generating a signal. Here's our daily chart. And I've been trying to point this out in the daily videos. This is a pretty healthy looking chart going up. If you just look at this without anything else on here, we were able to break above and stay above some of these pivot levels. We do have some overhead resistance above where we're at. The concern that I'm seeing is, you see how price was going up here? You see how volume is trailing off? That's usually not a healthy sign. No change in the decision point scorecard. All their trend models are up, where their PMOs are down in the short and long term. They're still positive in the intermediate term or midterm. We're still looking okay longer term with our trend channel. We're above the midpoint and continuing to advance. This is something I want to point out here, because last summer we were just rip-roaring up. We hit this longer-term pivot point, and that's where we topped out, and then we spent the rest of the summer going down. Now, we came up to this level and bounced back down. So that means when the market sees these things, these are important. We're coming close to this R1 level, which is at 5110. That may seem like an astronomical number right now. It's less than 100 points away from where we're at. If we do continue to go up, watch the 5110 level right around in there. If we do start to keep going up and hit some kind of resistance, this may end up being a resistance point that the market uses, because it's done that before, earlier in 2023 and then later in 2023. Looking at our trend, though, we're still looking positive. Price is above the red line and both are going up. We're also positive with our moving average crossover. We're showing some improvement here with the McClellan oscillator. This is one of the things that I'll point out later. We're seeing a negative divergence on the daily chart. You could make a case that we're seeing a negative divergence here, where the S&P has been going up and we actually going down with the McClellan oscillator. We are showing some improvement, but we're still below 0. So when we look at our summation index, we're coming down after being extreme positive based on price. We actually ticked up a little bit based on volume. We declined a little bit with the Swenlin trading oscillator, but we're still above 0 based on price and volume. We're seeing the same thing in the daily chart. We're the bullish percent index. And the thing I like about this indicator is it's not time-based. Moving averages can lag. And a lot of times I bring up, well, that's the way the indicator is calculated. Well, this just kind of takes what it is each day and then plots what's happening right now, where we came up to a really extreme positive rating at the end of December, and then we've been falling back and we're below 70. Now, we're still positive because we're above 50, but for the most part, we have been declining. Although we did see a little bit of a tick up both later in the week on the daily chart and a little bit of a tick up here in the weekly chart. And why am I? Oh, this looks like the Swenlin trading oscillator, but this is the PMO where our momentum is still longer term positive, but we are declining based on price and volume. However, we're still above zero. And here's our PMO study, seeing almost this exact same thing on the daily chart. We're showing some improvement with the PMOs that are rising, a little bit of an improvement with the buy signals. We're no longer extreme positive with the PMOs that are above zero, and this is actually starting to decline. We're not showing an extreme reading with our percent B indicator. We didn't close outside the upper Bollinger Band, even with our upward moves. So that's not extreme for right now. You can take this as positive because we're above the midpoint. We're also seeing the Bollinger Band start to widen out here as the market has been moving up. Here's all of our different oscillators that we follow, and we're positive across the board. We're turning back to positive on the daily charts, but we're looking pretty extreme, as we are here with the slope and TSI. We're looking better with the MACD and actually breaking out above this previous level, but we're coming back up to what could be considered an extreme reading. The PMO and the PPO are still positive. Those are two of our other intermediate term oscillators. And our long-term oscillators, the TRIX and KST, they're positive, but they're above this line, which often signals that they are extreme positive. And we're seeing a very similar story on the daily chart. So we're seeing a real convergence here. Chicken money flow, though, this is another smart money indicator. It continues to go up and the moving average is going up. You could make a case that maybe we're getting kind of extreme right now. And the chicken oscillator itself, it is already extreme. We're getting above this red line. That's a very, very high reading. Go back and look here. If you want to pause this and see when we had really high readings, what did the market do? It didn't always mean it reversed, but a lot of times it did mean that it ended up slowing down. The force index continues to be positive. We're above zero and it's advancing. We're still looking extreme positive with the money flow indicator. We had an up week, so we're above zero with the rate of change going back from this week to last week. The 50 period, we're above this red line, but we've gone above that before. But we're in that area where we're starting to look extreme positive. We just started to generate an extreme positive on the daily chart of this same indicator. We're also looking extreme positive with the RSI based on 14 weeks. We're turning back up, but we're still negative with the weekly special K chart. We're extreme positive still with the Stochk RSI, with the Williams percent R. We're still extreme with the ultimate oscillator, and we're really extreme. My gosh, we haven't seen this high of a reading on this chart. The blue line's up, which is positive, but it's just really going gung-ho here. We're on the daily chart, we've actually started to turn down, even though it's still positive. The Copic curve shows that momentum is still positive here. And because we're not dealing with any of these lines below current price, this chart really isn't helping us much. But we're still ticking back up with our 253 period average of the equity put call ratio. We want to see this go down if we're going to turn more positive, and it's been really choppy as we got off to a rough start in 2024. But when we look at the trend, the Heiken Ashi on the weekly chart is positive, the Kagi chart is positive, the Renko is positive, and the three-line break is positive. Looking at the ease of movement, we're starting to turn down on the daily chart. We're also rolling over a little bit here with the weekly chart. And we didn't have any new X's drawn in here. We didn't see enough of a price move for that. We're still working off of the last signal that was generated, which was a double top breakout on November 20th. Here's another momentum study here. In the long term, we're positive, intermediate term positive, and we're also looking okay right now in the short term. But remember, this is a weekly chart, so short term means something slightly different. But when we look at the trend using the Elder's Impulse system for the S&P, we still have solid green bars, which are positive. And we have dots underneath with the parabolic SAR, which is also positive. Here's some daily charts that I'm really noticing as of right now. This is an intraday chart. It's 10 minutes, and we're seeing some improvement when we look at the growth to value ratio. We were coming back up, and that's when we saw some pretty good movement in the market. Then we ran into some trouble. Now we're starting to see this improve, and this is more positive for the market. If we do start to go down, we're going to be watching this very closely because smart money buys on weakness, and so they may be buying a lot of these stocks if we start to see a decline in the indexes. Doesn't always work out that way, but we want to watch to see if that's what may happen. Here's an end of day chart showing how the small caps are really showing a lot of improvement when we compare growth to value. We're also seeing an improvement with the mid caps when we compare growth to value. And we're also seeing another sign of improvement here with the growth to value ratio for the S&P. These are all positive things. And we're also really breaking out here when we do a growth to value ratio using a slightly different way to measure that. And we're seeing a little bit of an improvement here after watching a negative divergence. We follow mainly the chart down on the bottom. This is the ratio between discretionary and staples, where the S&P had been going up. This is a daily chart. The S&P had been going up, and this ratio was actually going down. We are starting to go back up. We want that to continue if we're going to turn more positive. This is another thing that we're watching right now. This is the correlation between the VIX and the S&P. When we get above this dashed line, that's an extreme reading, and typically that's negative for the market. Well, we had one of those readings, and now we're starting to come back down, but the market's still continuing to go up. Is there some kind of a lagging effect with this? Are we going to get it wrong with this indicator this time? I've tried to mark other times when we had these same kinds of readings, and then what the S&P did after that. And usually, in a broad sense, it tends to be negative in the short and intermediate term. Now we're still getting an extreme reading with the skew index. Even though we spiked up and we've come down, we're still in this red area. This is another way of measuring sentiment. And this isn't as cut and dry. Sometimes this marked a top, sometimes a bottom, sometimes a continuation. Then this is one of the negative divergences that we're seeing. The S&P was going up, the McClellan oscillator was going down. So when we look at the summation index, the S&P was going up, but we were declining based on price and volume, and we're starting to flatten out a little bit based on volume. Sometimes with this indicator, volume tends to lead price, but we've also been fooled by that as well. Then when we look at the broader market, we are seeing some improvement with the NYSE McClellan oscillator. It actually crossed above zero, but as the S&P has been going up, we've been seeing the McClellan oscillator be under pressure. So we're starting to see a little bit of an improvement based on price with the summation index for the NYSE, but we're still declining based on volume. This is another negative divergence. We're going up with the S&P. We're starting to make lower highs and actually turning down with our 200 period moving average study. These are the stocks inside the S&P. Are they above or below their 200-day moving average? This is starting to decline. We're seeing that a little bit more pronounced when we look at the 50-period moving average because stocks cross those faster. The S&P had been going up, and we're seeing a negative divergence here. And why am I showing this one again? I guess if you didn't get it the first time, you can see it here. This was last week's chart. This was also last week's chart. For some reason, I didn't get rid of these things. This is from a week ago. What's going on here? Something is really messed up. Let me get back to a sane place. This is Dow theory, another negative divergence that we're watching. The Dow was actually down in Friday's session, but it's been making a series of higher highs. We're seeing a negative divergence with the transports. Also, we're seeing utilities under a lot of stress. Some broad market measures were in the month of February, and according to the Stock Traders Almanac, the first 6 months of the year tend to be the best, but February tends to be the worst of the best. So take that for what it's worth. And then we just look at the different indexes where we're setting new all-time highs with the S&P. We haven't even come back to previous highs with the mid caps, and we're even lagging a little bit further behind when we look at the small caps. But when we look at the Dow, we're still in a pretty solid uptrend. The NASDAQ is in an uptrend. The NASDAQ 100 is in an uptrend. And here's another weekly chart of the QQQs. That's setting all-time highs. The mid caps are showing some improvement, and we are in an uptrend longer term. And the small caps are also in an uptrend longer term. The NYSE, this is our broad-based measure that we look at. This continues to be in an uptrend, not quite back to all-time highs, at least yet. Looking at all stocks, they are going and setting new all-time highs. That's a positive trend there. The 30 biggest software companies are showing some improvement and are in an uptrend. The FANG index, it's setting new all-time highs pretty much each day these days, it seems like. ARC, there's something that I noted, but I haven't done a real in-depth study on this. Everybody was all the rage about ARC, and then about the time people were getting in at the very top, when everyone thought this is a great investment, and then it started to tank and people were losing their retirements, which I did a video on last spring that you're welcome to check out of ways that you could have avoided either eliminating or at least getting rid of most of the losses, even if you were wrong. But I've been just seeing some bashing arguments on Twitter and in a few areas of the financial media that I do look at, just raking ARK over the coals. Is that a time to maybe consider getting in? Just a thought. I'm not making any kind of a recommendation. But when all of the news is negative and everybody's blasting Cathie Wood and everybody's really angry because they got in at the top and now they've seen everything just evaporate. Yeah, I can see where a lot of people are very disappointed and very angry about that. But usually when the media comes out, a lot of times we can also use that as a contrarian indicator. But as I said, I haven't studied all the different articles that are out there. I just ran across more than I have recently. The KWB Bank Index, this is still holding up for right now. We're rolling over with the RSI, but it's still positive. We're coming down after getting an extreme positive reading with the RSI. We are seeing money still coming out of banks, even though this is going up. We see the negative sign over here. We look at just a plain chart, a weekly chart of Dow theory, where the Dow's making all-time highs. The transports haven't even broken out above previous highs, at least yet. And we're seeing the utilities showing some pressure there. So we look at the CRB index, where it has now generated a recent death cross. We're also seeing some weakness in the daily charts. Oil is still bouncing around in the 70 range for right now. Copper, it's still in an uptrend longer term, but it's not quite sure what to do. If we were going up, that would mean there's an anticipation of the economy looking better. If we're going down, that would usually mean that they're thinking that it's going to be economic weakness. Here's the dollar, which pretty much since the beginning of 2024 has been bouncing back up, even though it's in a longer term downtrend. We're still in a downtrend on the daily chart also. Gold, which there's a few gold people that I listen to, and I bring this up from time to time. No matter what happens, they always can rationalize it away. Well, gold might have been down, but the gold miners were up. Or just anything that you want to take your eye on here. But longer term, we're still in an uptrend when we look at the gold ETF. Silver is just kind of chopping all around. It didn't quite get back to a golden cross here, and now it's dropping below the moving averages. So that may be showing some weakness. And keeping an eye on interest rates and the price of bonds. We're still in an uptrend with the total bond ETF. We're also seeing where stocks continue to outperform bonds on a monthly chart. And this is what I've been watching and bringing up for a long time now, where this should be a negative result and we're getting a positive result. Is this foretelling maybe something going on in the banking sector? That's purely a guess on my part. I noticed this chart and we've been following it, and I'm not exactly sure why this is happening. Here are the yields on a daily chart where we had been declining nicely. Now we're starting to go back up more. There's a weekly chart of the international yields where you have the US and UK on top, followed by Germany, and all the rates are going back up. Even Japanese rates are going up. And then I've been showing this chart for the last number of months. This just suggests when we hit that 5% back in October, which ended up being a bottom in stocks, and then we started to fall, is there some kind of a bad thing that's going to happen that we don't know about yet? Is it going to be the banks? Is it going to be a war? Is it going to be a plethora of other things? You can go back and look through history when we spiked up and then started to come down. That pretty much always meant something negative happened after that. But we came down and now we're starting to go back up. We're not at 5% yet, but we are at least headed in that direction. So we don't know if this is an actual spike either. And then looking at real rates, this is a more recent chart that I got from Isabel Net. This just tops out, this shows that real rates pop bubbles. So we go all the way back when we were going up with interest rates, and then that's when we saw the dot-com crash. This is when we started to see the great financial crisis. This is when ARK was kind of gyrating all over the place. And this is when Moody's came out and actually, was it Moody's? One of the rating agencies came down and downgraded US debt. And we really saw interest rates go up after that, but then fall. This was also something happened geopolitically. This other little bounce back up, this is when things started to break out in Israel. Some relative studies. Here's an intermarket analysis chart where now we have oil back in the lead going back to the beginning of the year. A week ago, it was negative, followed by stocks, and then the dollar, where we have gold and the price of bonds, negative. When we do some comparisons between the NASDAQ 100 and the S&P, they're both doing really well. So they're in an uptrend. We're seeing the S&P 100 outperforming the S&P 500. We're seeing growth show some real improvement when compared to value. We're seeing gold really underperforming the S&Ps. The dollar's been going up, gold has been going down, and stocks have been going up. So that's why we're seeing this ratio decline. And we're also seeing this come back down as the dollar has been rebounding. And on a shorter term chart, we're looking how bonds are underperforming stocks. And this is breaking down to new lows. When we compare the low volatility ETF with the S&P 500, this is in a pretty significant downtrend. Discretionary is still holding up okay when compared to staples, but we want to see it do better than it has been. And energy is really underperforming the tech sector. So then some longer term studies, and I show these because once these are here, they're here pretty much indefinitely. And this was the NYSE breadth thrust. This is one of the stronger signals that was generated back in October 2022. Also, over the last year, we saw 2 ZWAG NYSE breadth thrusts that were generated. This is also indefinitely on the books and is more long-term positive. We're still getting a full-on buy signal with the Zohorchak method. That's positive, and that's longer term. Then looking at this long-term chart, going back to the 87 crash, we're above the trend line here. This is a shorter term version of that same chart, just going back to 2018, where we're comfortably above this line. If we do start to really fall down, we'll be wanting to see if this is going to provide support. But then we look at the NYSE new highs minus the lows. This is above zero and continuing to go up. That's also longer term positive. Yes, I know it's a moving average of a moving average, which breaks a cardinal rule of technical analysis, but that's why I do it. Then here, a 50-period moving average of the new highs, new lows just for the S&P. This is continuing to go up as well, and that's longer-term positive. Here's the NASDAQ 100. We are above this longer-term trend line. That's positive. But we're coming back up when we do a ratio between the NASDAQ 100 and the Dow. These are some high levels that we hit back before the dot-com bust and at the end of 2021 before we ran into 2022. Are we going to go higher? Is this even a big deal? A lot of perma bears are out there just licking their chops, thinking this is the end of civilization as we know it, just by looking at this chart. And you'll notice I don't do that. I don't base an entire scenario on one chart that I see. That's why I look at a multitude of different charts and then try to reach a consensus. When we look at the Qs to the small caps, we're also coming back up to this previous high level here. Is that going to be a problem? But we are continuing to see an improvement when we look at the cumulative new highs minus the new lows for the NASDAQ. It had been declining for years, and now it's starting to turn back up. And we're above where we were with the 3-month yield back in 2007, right before the great financial crisis. We're actually above, but for the most part, we have been coming back down, but we're ticking back up recently here. If this really continues to fall, we're wondering, is that going to give us a warning sign? And this just applies for Monday's session. This is our outlook. Our technicals are positive, but we are overbought. We're having to ask this question, is weakness starting to develop? It was looking a little bit more prevalent after Thursday, but not as prevalent after Friday. We are concerned with the idea that the S&P is going up, and we're seeing that on a decrease in volume. We're going to get the Treasury budget in Monday's session, and then we're watching the geopolitical events, which, as I keep saying, they just don't seem to have much of an impact on the market. Here's the upcoming economic calendar for the week. We're going to get CPI on Tuesday, retail sales on Thursday, and PPI on Friday. Seasonally, for Monday, February 12th, we're neutral to positive with the Dow. We're also neutral to positive with the S&P as well as the NASDAQ. We're also going to be entering into options expiration. So we're up a little bit more than we're down in that week historically. Now, this chart is looking okay when we have an upward January. This tends to show more follow-through strength in February. This kind of contradicts some other things that we're seeing. This is when we have they created a composite here, and we're actually above that right now, which is positive, and it could still come down and still be above this orange line and be positive. When we look at the Stock Traders Almanac statistics, we are pretty much going sideways, but we might be entering a period of some weakness. It's a little more pronounced on this chart. We're in February, and right about in the middle or so of February, when the sitting president is running for re-election, and we don't know if that's what's going to happen. Things did not go well with a press conference that he made, I think it was Thursday night, and that's got a lot of people really concerned. But anyway, that being said, the intentions are that he's going to be running for re-election. When that happens, we start off positive, and then we go through some seasonal weakness that lasts to the middle to latter part of March. This is put out by Dan Bird, where this is kind of what we're seeing here, where we might see some weakness. This actually develops and then shows some improvement here within February. It's more in March where we tend to see some more weakness. February is the worst month of the 6 best months, and they tend to be down even during an election year. We will be in Monday's session, where it tends to be the most positive day of the week. So we have that going for us. And then we will be on the 8th trading day of the month, where we do see some positive seasonality for the S&P during an election year. Why are these things showing up again? I don't know what happened here. This is a wrong chart. This chart here, we don't know if we're really sticking to this or not, but there was a period in time when we were tracking what was happening in 1982, which was how 2023 was playing out. And when we did that, we saw some real strength going forward. We're wondering if that's going to happen this time. And then when we look at from 1950 up to 2023, the S&P, it's up a little bit more than down on a percentage basis, but we end up having a negative return for the month. So, and this is just going crazy here with my slide. I checked through all this and I didn't see all these weird things going on. We're not going with the down scenario for right now because we're still looking more positive. We need to see some confirmation based on price and then also followed up by some of our indicators. So if anything, we're leaning more to the positive side, but be aware, we are overbought and we are potentially entering in a period of seasonal weakness. We're not going with the sideways trend because on the weekly chart, the daily chart, our short-term and intermediate term, all of those charts suggest that we are in a trending environment, and the green line is on top for all of those. So it's positive. The warning signs, we're worried about volume decreasing as the S&P has been moving higher. The risk-on posture just hasn't been helpful to us lately. Our oscillators on the daily charts, they are positive, but they're extreme positive. The McClellan oscillators and summation indexes are negatively diverging. Small and mid-cap growths are showing some improvement, but longer term, when you look at their indexes, they are still negatively diverging from the S&P. Discretionary has been negatively diverging from the S&P as well, even though it might be showing some improvement. And the transports are negatively diverging not only from the Dow, but also from the S&P. We're kind of in no man's land right now. The NDX is trying to get a little bit above its moving average when we measure using the PPO. It had started to drop down below its moving average, and now it's starting to go back up. And stocks are entering a period of historical seasonal weakness. This is not a done deal. This is something, oh, you can take this to the bank, sell in February and go somewhere else. Isn't there some kind of a saying like that? But historically, what we have seen is about the middle of March, till about the mid to even latter part of March, sometimes we see some seasonal weakness. Longer term, we're still above those long-term trend lines that I showed you. The 1 to 3 month short-term bond spread, it continues to be positive and has been now for quite a while. And we're still above the pre-Great Financial Crisis levels with the 3-month yield. That goes back to 2007. Earnings can be either positive or negative. Positive signs. We are seeing some growth back up. We are seeing some improvement with growth with the small caps, with the mid caps, and even with the S&P. And then our oscillators, this is another positive thing because they're back above their moving averages, but they are extreme. The 5 period is going down, which is positive. It's the 253 period that's still chopping around and possibly going up. The parabolic SAR and vortex charts continue to be positive. The bullish percent index for the NASDAQ 100 is positive, but it's still above 70, so it's extreme. The Copic curve is positive. We are seeing an improvement when we compare small cap and mid cap growth to value. Financial sector for right now still continues to be positive. Longer term, the daily special K chart is positive. The weekly chart is still negative. Our longer term 253 period equity put call ratio is still going down. The Zohorchak method, though, is positive. This is actually incorrect. We're chopping around with the 253. We actually haven't turned down decisively yet. And then we are seeing longer term uptrends with the Russell, the small caps, and the mid caps. Our longer term new high, new low study is positive. And then we look at the S&P and compare it to the NYSE, new highs, new lows, longer term, they continue to be positive as well. And then over the last year, we've seen two ZWAG NYSE Brett thrust buy signals, and those are indefinitely on the books. Seasonally and historically, February is the best of the first 6 months. And then there's something at the bottom here where we have longer term setups and seasonality, which remains. I checked this before I recorded. I didn't see this spacing problem. So our conclusion, and this is just for Monday's session, we're positive, but we are overbought. We want to just keep an eye on watching for some weakness that might be developing, and the fact that volume is decreasing as price is going up is a concern. We're watching pretty much that same thing in the short and intermediate term. In the long term, we're overbought because our longer term moving averages have gone back to being extreme positive, but we are still positive. Thank you. I really hope you found this helpful. I will be posting the intermarket analysis after this. I hope you're having a great weekend, and I will talk to you in the next video.